Hello, and welcome to today's session, Global Sustainable Investment Views. This webinar is part of the Deep Dive and Keep Going series put together by BBVA. Thank you for joining us today. For those who don't know me, I will introduce myself. My name is Nicolás Trillo, and I've been working for BBVA for over 15 years, covering public sector institutions for over 10 years. Just a few housekeeping notes before we get started. The webinar will last about 1 hour and it is being recorded. So don't worry if you miss something. We will be sending around the on-demand recording when it is available. Today, we will discuss how sustainable investing is transforming all asset classes. Climate change and the energy transition are having and will continue to have a transformational impact on the global economy. For the last 5 years, the ESG asset class has grown at an exponential rate. ESG assets have triggered the interest of millions of investors globally. As many investors are willing to integrate ESG into their investment strategies, we believe it is the right time to shed some light on it. We'll try to make it as interactive as possible, and for that purpose, we will be asking questions during the webinar and will dedicate around 15 minutes to run a Q&A at the end. We encourage you to send questions during this session, and we will try to answer as many as possible during the event. And if not, we will read you after it. So use the orange chat bot that appears on the right of the screen. Today's speakers, Ana Munera, Head of Global Market Research, and Isidoro del Álamo, Head of ESG and Equity Content, have put a very impressive deck of slides to discuss how the business cycle from a cross-asset perspective is being affected by the energy transition in a structural way, and how sustainable investing is transforming all asset classes. And now, without further ado, I will hand you over to Ana Munera, that is going to cover how the energy transition is affecting the business cycle. Over to you, Ana.
Thank you, Nico, and hello, everyone. It's my pleasure to be here today and share with you our views on how the sustainable investment landscape is changing following the pandemic and in the wake of the more structural changes related to IT, the globalization, and the energy transition. All of them, for sure, deeply interconnected. Our presentation is organized in two main parts. The first one is focused on how the energy transition is interacting with other structural and cyclical forces, and how it is reshaping the real and financial cycles. All of this, for sure, with serious implications for investors. The second part is more related to the integration of ESG factors in investment decision and financial analysis from a sector and bottom-up perspective. As I have just said, and starting with slide 2, I would like to talk first about the increasing dominance of structural factors on financial scenarios and how this is changing the traditional model of interaction between economic and financial cycles. Just to give an example, the impact of structural forces such as the IT revolution and globalization were particularly relevant in the configuration of the asset cycle in the aftermath of the financial crisis. In this globalized economy, the different orientation of capital flows led to massive difference in the degree to which countries adapt to IT, widening the divergence in economic performance between countries, driving an straight out performance of US assets during this year. In our view, the increasing interaction of this structural factor with the economic cycle has created a growing decoupling between economic and financial cycles. As you can see in the chart from the presentation, where the correlation between our proprietary macro and financial index has fallen over time. This is an important development, also explained by changes in the policy mix, with the new framework of monetary policy foremost in everyone's mind. If we move on to the slide 3, going forward and after the health crisis of 2019, a greater commitment to climate change and ESG are set to become a new structural factor with a long-lasting impact on economic and financial cycles. the global sustainable investment universe topped $35 trillion in 2020 and could reach more than 50 trillion by 2025. ESG investing has also grown exponentially. From an asset cycle perspective, I would focus mainly on the climate change factor, much more than on the S and on the G that probably Isidoro will cover later. Given the tremendous acceleration of net zero commitments from both governments and corporations, this is clearly going to be a transformational issue. Just to give an example, as of February 2021, governments that have already shown their commitment to climate change represent close to 70% of global CO2 emissions. Despite this greater commitment, it is important, however, to bear in mind, as the slide shows, that not all zero climate scenarios are equal, and that there are important differences in the physical and transition risk implied by those scenarios. Just to be more precise, physical risks are defined as those risks that arise from the interaction between climate-related events and human and natural systems. For example, the volatility in foods and oil prices follow a drought or a flood. Transition risk, however, on the other hand, should be defined as the risk of economic dislocation and financial losses associated with the transition to a lower carbon economy. Depending on the scenario and the speed of this transition, the intensity of the physical and transition risk, as the chart shows, could differ, with implication not only for the economy, but also for the asset cycle. If we go now to the slide 4, actually, climate targets, such as those proposed by the International Energy Agency, have become even more ambitious as time goes. And this represents an increasing challenge ahead. Those already familiar with the IEA Sustainable Development Scenario will not be surprised. However, while the difference in temperature targets between different scenarios could look small, less than 0.15 degrees, the pace and the magnitude of the shift in the deployment of decarbonization solution and its implication in terms of supply and demand are staggering. In this regard, it's worth mentioning that the latest IEA scenario represents a huge task in terms of the industrial challenge. The annual capacity addition of renewable power should be 2.5 times higher than in 2020 throughout 2030. And just to give another example, the electricity production needed to feed hydrogen electrolyzers by 2030 is equivalent to China's incremental electricity needs over the last decade. But beyond the industrial challenge, there is also a financial challenge. Energy investors are set to rise from 2.5% to 4.5% of GDP by 2030, with clean energy investment needing to be 3 times higher than in the 2016-2020 period. That is really relevant. And this is what we want to analyze going forward. Turning now to the slide 5. In the same vein, greater and more ambitious official commitments to climate change and ESG are set to have a structural and relevant impact on economic and financial cycles. As we have just commented, given the complex nature of the interaction between physical and transition risk, only a small difference in the temperature target could create an important shift in the necessary deployment of resources. To illustrate this point, it is important to bear in mind the underlying nature of the potential impact of the physical and transition risk already described on the supply and demand side of the global economy, as shown in the table that you have in front of you. Among these risks, I would highlight those related to energy supply, the deployment of resources, and the uncertainty about the rate of innovation with profound implication on future inflation and incentive for CapEx decision. Moving forward to the slide 6, at this stage, it seems quite straightforward that one of the more relevant transition risks is related to the deployment of enough capital and financial resources. Just to give some figures, the International Energy Agency says that in the power system alone, $1.2 trillion of extra annual investing will be needed over the next 20 years. In terms of total investment, that would amount to more than $3.5 trillion. This is a huge amount of money. Much has been said about the key importance of public investment initiative. And it's true, there has been ambitious initiatives over these years, as the infrastructure bill in the US that is on the process to be approved in the coming months. And for sure, the next generation European Union package, more than $170 billion in short program. However, private investment is still the constant of any credible energy transition scenario. All in all, and despite all these public initiatives, in 2021, we are only at 35% of the investment needed for the energy transition. Even more, according to the OECD, only 59% of the total global financial packages that has been approved to accelerate the recovery from the COVID impact has had a positive environmental impact. So, just if we move to the next slide, just the slide 7. Here it is. It is needless to say that the second most relevant transition risk is related to the deployment of sufficient financial resources. In order to have enough funding for this new CapEx cycle related to climate change, capital markets for sure has played a key role. In fact, issuance of sustainable debt is on track to another record year, with sustainable debt issuance close to reach $1 trillion in 2021. That said, the banking sector, especially in Europe, is seen as a key player in the transition toward low-carbon economies, supporting the financing of new greener technology and managing the decarbonization. Initially, the banking sector is actively trying to identify and manage lending business exposure to at-risk sector, which may be vulnerable to both physical and transition climate risk themselves. Having said that, the latest ECB stress exercise regarding stranded brown assets shows that even in the worst case ECB hothouse scenario, it's unlikely to see a higher probability of default before 2035. Banks still have time to avoid potential losses if they move quickly. If this is the case, and going forward, investors will probably broaden their focus away from losses on brown assets to green financing opportunities, which could deliver revenue growth with significant potential extra upside for European and in the future global banks. All of which suggest that the banking sector is playing and is going to play a key role in moving financial resources into ESG projects. In fact, loans linked to ESG are growing now at double-digit rates. If we move to the next slide, and as a result of this combination of factor and risk, we should analyze how the transition to net zero emission has also potential implication for inflation in a context of a still suboptimal level of CapEx and investment. When talking about inflation, the first things that come to our minds is related to climate risk. For example, agricultural yields could be hit and could cause higher and more volatile food prices. But in terms of physical risk, the worst of these weather-related impacts will not come until probably 2050. Over the next few decades, the main risk to inflation beyond cyclical and demographic forces are most likely to come from mitigation policies themselves, the transition to net zero emission. Tackling climate change entails inflation risk. If you do too little, too late, and this is something that for sure regulators have in their minds. Having said that, there are also risks if you go too fast. So moving now to the next slide, slide 9. This greater than anticipated inflation rate should be taken into consideration by companies in terms of cost, margin, and also, of course, return on capital employed, but also for investors, given the increased role of the alpha beyond traditional sector rotation. According to official and private sources that have modeled these client scenarios, the impact, only for you to have in mind, on the global economy of a rapid shift to genuine sustainability would be similar to the 1973 oil crisis, which led to a prolonged bout of high inflation. In our view, offsetting such a shock would be even harder this time, as economies would need to invest not only in making the transition, but also, and this is really important, in compensating for the loss of existing capital stock as fossil fuel resources become stranded. The strong correlation that you see in the slide between the EU ETS price and the oil price is a clear example of the negative feedback loop that could be at work during this energy transition. In the next slide, and as inflation concerns become more evident, it is expected that the debate between delaying decarbonization or lower cost transition pathways could intensify. If net, only for give you some figures, if net zero policies were introduced abruptly to bring down emissions even more quickly than is anticipated now, the impact on inflation could be even more significant. Take carbon pricing, for example. Only 21.5% of global greenhouse gas emissions are covered now by carbon taxes. The IMF estimates that the average price globally is around $3 per ton, and that it needs to be $75 by 2030 to be on track to limit the rise in global temperature to 1.5–2% goals. All in all, a repricing of global CO2 emission of this magnitude would increase their aggregate cost by an equivalent of 3% of world GDP. This, just to put some image on that figure, would be similar to the repricing of oil consumption during the first oil price shock in the 70s. Moving to the following slide. And in terms of the investment cycle and return on capital, supply chain problems could determine for sure the return on most investment projects. And this is something that, given the capital needs that we need for the energy transition, is clearly a critical factor to look at. To isolate how the E of the ESG have implication in terms of CapEx and inflation, and how this could translate into corporate financial performance, we have to move to a factor analysis. From a CapEx perspective, the main transmission channel from CapEx to earnings is clearly the return on capital employed. The return on capital channel, in our view, going forward, is going to become even more determinant. It mainly relates to the expected return that companies are planning to obtain from their CapEx decision. And ahead of the new CapEx cycle, this is going to be increasingly relevant for company valuation. Even if we look at historical return, and as you can see from the slide, the return on capital has already been a critical differentiating factor in terms of performance. In this regard, it would be worth bearing in mind that historically, the market has rewarded the return on capital in terms of performance, but also in terms of simple valuation metrics, as the chart on the left suggests, where of course the fifth quintile has better performance and for sure much better valuation metrics. How this return on capital interact with inflation, pricing power, and efficiency gains will be, in our view, critical to understand the outperformance of value companies during periods of higher than expected inflation. If we move to the slide 12, the following slide, what does it mean in terms of ESG strategy performance? Has there been a more relevant impact on sector and companies than on index? From the previous analysis, we need to understand why companies with a good ESG score have not outperformed so far in 2021, mainly because rising inflation expectation and increasing capital needs. Renewable utilities and clean energy stocks have in fact underperformed, as you can see from the table in your slide. All of these sectors, clean energy and even healthcare, are all of them high growth, long duration sector, and sector with a negative correlation with inflation and rate hikes. On the other side, mining, oil, and other non-ESG sectors have outperformed. In fact, energy, materials, financial are mainly included in what we call the value indices. We have positive correlation with inflation and a gradual upward move in interest rate. Meanwhile, ESG index and inherently overweight in growth sector that, as we have said, have negative correlation with inflation expectation. We move forward, and from a top-down perspective, The relevant question is what portfolio managers or investor can do to outperform the benchmark in this new scenario with higher probably than expected inflation. The simple answer is the one that you have in the slide 13. Look for stocks with short duration and good ESG sector and good ESG scores, consumer discretionary. Look for ESG stock with positive correlation with inflation and interest rate, energy, materials. Search for financials that have the most credible plans intends to realign their asset portfolio with the Paris Agreement. And look for stocks with pricing forward that are good ESG improvers or enablers. For sure, look for sector with benefit from high inflation and commodity prices. This is the oil and mining sector that we have been mentioned. But in practice, and despite all this recommendation, this is going to be much more complex. And we would need to, as Isidoro explained later, integrate in this analysis the bottom-up perspective. If we move to the slide 14, the next slide, from a bottom-up perspective, it makes sense to have an integrated approach and to really understand the intrinsic value of the different sectors. We need to widen the scope and include the ES factor in a more comprehensive way and integrate this factor with other macro factors related with inflation, CAPEX, in order to identify the best ESG investment opportunities. The integration of the ESG factor from a bottom-up perspective with the changes in this macro and top-down scenario would be critical for good performance in the coming years. In our view, this integration will help us to outperform the benchmark and drive absolute return, which are going to be increasingly relevant in a higher inflation environment.
Thank you, Anna. Thank you for sharing your views on how the energy transition is interacting and reshaping the real and financial cycles. We have been receiving some questions during your intervention. I will put together the question to the end. I will try to arrange that for topics. So I think that is now time to move to analyzing how sustainable investing is transforming all asset classes and provide some insights in selected sectors of relevance. So Isidoro, how do you think sustainable investing is transforming the global market?
Well, hello. Hi, everyone. I'm glad to be here and have the opportunity to discuss sustainable investing. Okay, let me first explain what we understand for sustainable or ESG investing, and then we'll try to address how it is transforming the global markets. ESG investing could be defined as something as simple as the consideration of environmental, social, and governance factors in financial analysis. In other words, the incorporation of non-financial factors as part of the analysis process to identify risks and opportunities. As simple as that. ESG investing and analysis have become of increasing interest for investors as globally governments, asset owners, and investors in general consider the impact of ESG factors on their investments and their own local markets. Equity and fixed income investors are incorporating ESG data into their investment process to gain a kind of all-inclusive understanding of the companies in which they invest. This greater interest has resulted in massive flows into ESG funds and new types of financing in the capital markets like green, social, and sustainability-linked bonds, among many others. And as we will try to explain throughout this webinar, we believe more thorough consideration of ESG factors by financial professionals can improve fundamental analysis and ultimately lead to higher returns. So now, how are investors approaching ESG investing? Well, there is a wide variety of strategies when it comes to ESG investing, from kind of light green categories like screening to dark green categories like impact investing. Investors may choose or combine some of these strategies. They don't have to be exclusive, and they can combine many of them at the same time. And for the time being, we would say that ESG integration and screening are the most widely used methods. But so far this year in 2021, integration, which is as simple as consider ESG ratings and scores in the analysis, is becoming increasingly popular as there is more ESG data and ratings grow rapidly, I would say.
But Isidoro, let me ask you something here. Many investors are willing to integrate ESG into their investment strategies, but they all have to deal with the same dilemma. Is ESG investing profitable? Does it generate alpha? Is there a premium for fixed income investor? So I understand there are many questions, but
Yes.
maybe you can say something here.
Well, let's see if I have the answer, Nico, because the answers to this type of questions are very difficult or far from simple. Okay, in our view, the simple integration of ESG factors in the investment process does not necessarily deliver higher financial returns, as Anna mentioned before. The preferred approach out there for ESG integration by investors is to rely in proprietary or third-party scores or a combination of both, with no further analysis of other key ESG issues like disclosure, internal policies at the corporate level, or exposure to specific risks. So this strategy does not guarantee high returns in our view. In fact, this primary approach to ESG integration could have delivered some outperformance in the equity market so far, but it appears to have been limited and not necessarily sustainable. This appears to have been the case so far in 2020, and for illustrative purposes in the slide, we analyzed the performance of the top ESG scoring companies in two different sectors. This is utilities and the auto sectors, and versus their benchmarks. And there you can see that both examples suggest that the ESG rating itself is definitely not sufficient to generate outperformance. In the credit space, not all green bonds are issued with a premium, or what investors like to call greenium. Since 2019, 625 bonds have been issued, and we have analyzed 467 of them in the most active sectors: autos, utilities, oil and gas, and telcos. Overall, in non financial corporates, there seems to be greenium, but we also see a clear correlation between a green bond and a greater appetite or higher demand from investors. This is because, despite having grown, the offer is still small in the overall context of the bond markets. In other words, many would argue that the vast majority of green bonds are less liquid and therefore priced tighter than the curve, meaning probably the greenium is explained due to this issue. In our view, basic ESG integration is therefore static and short-lived, as it does not anticipate future ESG rating upgrades or downgrades and does not avoid exposure to critical risks and controversies.
But based on your own experience, Isidoro, how do you think investors can integrate ESG and achieve at the same time attractive financial returns? Not an easy question, but
No, you're complicating me the webinar with Nico. Okay, we do believe ESG can turn out to be a decisive factor for future performance. Let me explain. In our view, ESG scores are lagging indicators. This is because they are not updated on a regular basis or fast enough to follow corporate announcements and changes. So, therefore, being able to anticipate changes in ESG ratings could prove very lucrative for investors. Companies that receive ESG score upgrades, what have been called ESG momentum or ESG improvers, usually outperform the market in the following months. And this is even clearer in those companies that have a low ESG rating. In this slide, you can see the performance of two different companies in the same sector, like Equinor and Total, to their benchmark, and how ESG upgrades in the case of Equinor and downgrades in the case of Total seem to have had an impact in the stock prices. We therefore believe that the combination of fundamental and ESG analysis, together with the active monitoring of the management of risk and controversies at the corporate level, which is clearly a step beyond basic ESG integration, can lead to the anticipation of ESG rating upgrades or downgrades, and therefore generate alpha for investors. We try to differentiate between laggards and leaders at the sector level. Instead of simply excluding an entire sector, like the oil and gas, for instance, we take a close look at the laggards in each of them in the search for a better disclosure, enhanced resource allocation, the implementation of medium-term environmental goals, internal ESG practices, whatever, that could lead to ESG rating upgrades, which could lead to better performance. This improvement or positive ESG momentum stories could have been largely underappreciated for many investors due to the use of exclusion or negative screening ESG strategies.
Isidoro, so if I understood you correctly, and here is the crux of the matter. So exactly how do you integrate ESG in your investment criteria? I think, can you go more into the point?
Of course. Okay, let's hope this is not the boring part of the webinar. Let's see if I can explain it quick and easy. Okay, we follow a bottom-up approach, as I said, combining ESG and conventional financial analysis. This combined framework is data-driven, and it targets to assign a kind of tangible value to the company's ESG profile and the way corporates manage environmental, social, and governance risks. We have designed our own proprietary scoring methodology, which is based on a materiality analysis that sets the main ESG standards across sectors. We then set generic and sector-specific KPIs for each of the E, S, and G clusters with clear and simple methods, and we end up producing ESG scores. But importantly, and this is key, we do not simply rely on our scores. We integrate them with the ones of several well-known and trusted third-party providers. And we do not only consider these third-party providers for the ratings, but we also look into their particular views and thoughts on specific risks and controversies. Therefore, we go beyond um, basic ESG ratings integration to address what we believe are the current deficiencies of the ESG industry, like um, limited and inconsistent data, heterogeneous scoring methodologies, slow and inefficient score updates. This is our way to go beyond these problems. We also analyze the way corporates manage ESG risks and controversies, their medium and long-term environmental goals, and if they are aligned or not with the Paris Agreement. And for this, we use publicly available initiatives like science-based targets or the Transition Pathway Initiative, and other public sources like Carbon Disclosure Project, Climate Action Tracker, among many others. Then we integrate all these ESG analysis as another key factor in our conventional financial analysis, the one Anna mentioned before. We therefore consider five main factors, which is quality, growth, value, financial health, and ESG to define the best stock picks within a specific universe. So to summarize, hope it's been quickly enough. Our overall approach is rooted in data. It integrates conventional and ESG analysis, and it is focused on change in order to try to anticipate future outperformance.
So very interesting, Isidoro. I promise not to interrupt you anymore in the
Don't
rest of
worry,
the
Nicolás.
slide, but one of the keys would be to go beyond basic ESG integration by analyzing climate strategies among other issues. So maybe you can now give us some examples by sector.
Of course, happy to do so. Okay, let's start with the autos sector. Okay, we do like a three-level analysis. From the point of view of sector allocation, we believe autos is an attractive option to gain exposure to cycle normalization. Additionally, autos are positively exposed to rising inflation expectations and the kind of a scenario Anna was mentioning before. Then we go from a fundamental point of view. We also believe the sector has a very interesting outlook. In fact, transport demand is expected to grow across the world as global population increases, income rises, and more people can afford cars. In fact, according to the International Energy Agency, if I recall correctly, global transport demand will double and car ownership rates will increase close to 60%. So all these catalysts should drive a recovery in vehicle demand, earnings growth, and cash flows. Furthermore, despite the recent outperformance of this sector, the Stoxx Europe 600 Automobiles Index relative valuation remains near record lows. In fact, it's trading at 7 times earnings 2023. So all in all, autos are among the cheapest sectors globally, with one of the highest earnings momentum. Then in our analysis, we go to the how climate change and the energy transition is impacting this particular sector. And as we explain in the following slide, we believe that this is key for this sector because transport currently accounts for 16% of total CO2 emissions. So, and higher demand, as we were mentioning before, will imply higher emissions going forward. So this is a reason why we believe electric mobility has a role to play in the fight against climate change and is key for this particular sector. By 2030, the global electric vehicle fleet is expected to reduce greenhouse gas emissions by in between 33 and 66% compared to an equivalent combustion engine fleet. So we believe the electric vehicle technology will allow traditional OEMs to report growth and higher cash flows and margins in the future. And as a reference, we expect the global electric vehicle fleet to grow from just 11 million vehicles in 2020 to in between 150 and 350 million vehicles by 2030 and close to 2 billion by 2050. So you can imagine the growth profile we have in the future. Finally, in the following slide, we analyze the sector in detail through our factor screening and ESG analysis. Here in this slide, you will see how we focus in companies that enjoy a strong fundamental position and also solid ESG ratings, and also all the analysis we mentioned before. We analyze all the specific risks and controversies, their environmental policies, and if they are aligned or not with the targets of the Paris Agreement. This is how we end up selecting our preferred ideas. Then, if we move to a less or a more counterintuitive example, for example, the oil and gas sector, we could argue that this sector is despised by many investors as the energy transition could end up anticipating the end of fossil fuels, which are likely to become stranded sometime this century. And at the same time, this sector is exposed to specific risks and controversies from an overall ESG perspective. Okay, so let's try to explain why we do like this sector and where we can find opportunities. Our fundamental view on this sector is also positive. That's to start with. It generates double-digit free cash flow yields, it pays decent dividends, and it should benefit from the rise in commodities. In fact, consensus now expects Brent to remain in between $60 and $70 per barrel in the coming years, slightly below current spot levels, but it's still high enough. And this is because the renewed global demand and the constrained supply. Okay, so moreover, despite being the sector with the highest EPS estimates upgrades over the recent months, it continues to trade close to 20% below pre-pandemic levels and close to 50% with a 50% discount in relative terms with its benchmark. Additionally, the energy sector, as Anna was saying before, is one of the clearest equity hedges against inflation. It is a natural short duration tactical inflation hedge, if we let it put it that way. Now, second part, how is climate change impacting this sector? Well, in the following slide, we explain this and we say that climate change is impacting this sector in many different ways. On the positive side, companies are shifting exploration capex towards renewable and clean energy alternatives like hydrogen. This could help to sustain higher prices due to possible greater production costs and reduced oil supply. And this is positive for this sector, as in the short and medium term, the core business should remain the biggest source of profits. On the negative side, if the world meets the goal of the Paris Agreement, as Anna was mentioning before, almost 50% of oil and 30% of existing gas reserves will become stranded by the end of this century. In other words, the total today's value of oil and gas production could fall in between 25 and 50% by 2040 compared to 2019 levels. This is clearly what concerns investors. We share that concerns, but we also believe that there are companies in the oil and gas industry that could turn into a good investment opportunity. And this is first, because their exposure to stranded asset risks could already be largely priced in by investors. And second, because many of these companies are committed to the goals of the Paris Agreement and could be seen as ENG improvers for investors. Finally, I would like to give a third example, which would be the utility sector. This sector has been the first mover, definitely, in the energy transition, and its ESG angle and equity story seems to be far more clear for investors. Putting it simply, if the world wants to become cleaner and greener, which is definitely what it wants to become, it can only be achieved through the electrification and decarbonization of the economy. And as Anna mentioned before, the energy transition needs cumulative investments of more than $100 trillion up to 2050. So in that period, global renewable capacity will have to grow by more than fivefold to more than 50 terawatts. On the question on future profitability of renewables, given this increasing competition and the impact of inflation, of course, we are not too concerned. Despite inflation, renewables today continue to be much more competitive than years ago. Solar PV and onshore wind remain more competitive than new thermal power generation in many regions, especially now that oil and gas and CO2 prices are reaching new highs. And what is even more important, spot electricity prices have also rallied, meaning that they are providing positive signals for future PPA contracting for renewable projects in the future. Admittedly, this sector has performed better than most stock market indexes, not in 2021, but the 5-year performance is still impressive. And we believe the renewables and utilities probably is not a cheap sector, but neither it is expensive, especially if we consider the growth profile in the future. If we look at the enterprise value to EBITDA multiple of the renewables and utilities sector, it has expanded, but this is mostly explained by the earnings growth expectations. So if we look at the future, we could argue that investors are pricing in growth up to 2022, 2024 in most cases, but no growth beyond that date. And this is very important because we believe that investors will be willing to provide more growth optionality to these stocks, more aligned with the long-term framework of the energy transition. So all in all, we believe that investing in utilities today continues to be a very attractive proposition, and through our combination of financial and ESG analysis, in the slide you can see a few corporates that we believe could be attractive. Sorry if that took a little bit too long. Hopefully it was self-explanatory.
Thank you, Isidoro, for elaborating on how sustainable investing is transforming the global market. Let's go now into the Q&A session. As I mentioned before, we have been receiving some questions during the presentation, and I have tried to organize that question by topics. So let's go to the first topic is regarding inflation. Some questions about that. Specifically, you have been talking about the inflation risk and what it means in terms of the interaction between ESG and value factors. So some of the questions are related to, do you think that fixed income and or equity markets are currently pricing in any structural inflation risk? I believe this question could be for Anna. So Anna, maybe you can answer.
Thank you, Nico. Yes, for sure. Well, I would say that bond market indicators in fact, so that market is convinced that inflation is transitory, I would say. The 10-year nominal yield, in the case of the Treasury, the 10-year Treasury, has fallen from 1.7 to 1.4 in just 4 months. The 5-year forward imply inflation metrics, even in the US, revert to levels around 2.3%. So it means that the market is pricing that despite the spike in inflation in the short term, in the medium term is going to converge to levels slightly above the 2%, even in the US. When you look at the equity markets, equity market valuation tell the same story as growth and long duration sector are still trading, as Isidoro has just said, at an all-time high premium versus the market, even despite the underperformance of this year. I would say that this situation is going to become particularly relevant because plenty of indicators suggest that inflation may be more widespread than consensus could be originally anticipating. If this is where the case, this quickly could fit through the rising bond yields, and this could rapidly change market perception about how transitory inflation is likely to be. In our view, this is clearly a relevant risk. And we believe that integrating this rate is going to be the only way to avoid an additional concentration of exposure on long duration sector, even as Isidoro said, if they rank high in terms of ESG, current ESG scoring. From a bottom-up perspective, pricing power clearly is going to become in the coming months one of the most relevant factors to mitigate the impact of higher than expected inflation on the earnings of the companies.
Okay, thank you, Anna. We have also some questions about the ESG investing. I believe this could be for Isidoro. The question is, how relevant is ESG investing so far? Where is it headed in the near future? What is the current positioning of ESG funds? Is there a bubble? So this is the most important question. Is there a bubble? So maybe Isidoro, you can elaborate from here.
Okay, Nico, thank you. Let me try to answer one by one, and let's hope I don't forget any of them because there were 4 or 5 in one. Okay, so how relevant is ESG investing? A great deal, I would say. So for the last years, the ESG asset class has grown at an exponential rate and has led to increasing issuance levels across all areas, specifically in Europe, but also in the US and more recently in Asia. Today, the global sustainable investment universe, all asset classes, has already topped 35 trillion by the year 2020. And in the credit space, issuance has surpassed close to 700 billions so far this year, which is double the pace of last year, and it's likely to go beyond 1 trillion, as Anna said before. So clearly a great deal. Second question was on what is the outlook for the future for ESG investing, if I recall correctly. Well, despite this expansion and how it has evolved in the recent years, we would argue that it's still small in an overall perspective. So let me put an example. If we talk about green bond market, for instance, which is the largest by size in the sustainable debt arena, is less than 1.5% of the global bond market. So this can give you an idea of how much this ESG universe can still grow. Then the question on positioning on ESG, well, this is especially relevant in our view because we believe that monitoring where ESG funds are investing today could be a very useful tool also to identify future opportunities in the selection of ideas. Well, global ESG funds position continues to outweigh significantly industrials, technology, utilities, and materials. So this means all the sectors aligned with the energy transition. And on the contrary, ESG funds traditionally they underweight financials and energy. So here you could see where the opportunity could be, and is very much in line with our thoughts. And finally, is there a bubble? Well, that's a very good one. Well, we don't think so. It's true that pure plays in hot topics like climate change, like renewables or hydrogen, companies involved in the hydrogen value chain, appear to be overheated. It's true. But we also believe it's very difficult to argue if we're in a bubble or not, because growth expectations are huge. For instance, in the hydrogen market, depending on which part of the value chain, but you could argue that demand could grow 100-fold in the next 10 years. So is it expensive? We don't think so. We believe that you could argue the valuation multiples, but we could also argue that it's probably better to play sectors which are cheaper and are this kind of ESG momentum and ESG improving strategies.
Okay, thanks, Isidoro. I think you didn't forget any of the questions. We have also some interest with the banks, with the financial sector, and the link with sustainability. And I mentioned before about the growth opportunity for banks, and there are some people in the audience that are asking, why do you think that despite the climate and transition risks banks that the banks are facing, the green transition is a growth opportunity for banks?
Well, this is a really good question, Nico. Yeah, you are right. We are more optimistic about well, the growth opportunity for global banks from financing the green transition. And this point of view primarily reflect well, new studies that we have been commenting during the presentations, which point to much larger investment and financing needs than previously thought, suggesting what we were saying, that we are going to have $3 to $5 trillion gross financing needs per annum over the coming years. Moreover, it's true, and we have seen in the third quarter results that global banks have significantly scaled up their green financing ambition over the last quarters. The key question, of course, is, and this is difficult to answer, how much of this green financing opportunity is incremental and how much is simply replacing a legacy carbon intensive brown business. We believe net that the energy transition could create an additional net financing opportunity close to $2.3 trillion for banks in between 2020 and 2050. On average, this could represent a 50% increase in the total annual global financing volume of right now it's close to 15 trillion of US dollar. So it's clear in our view that it's a huge financing opportunity what we have ahead. Unfortunately, we do not see, and it's true, we have to accept that there is no immediate catalyst in the next month or for the next 3 months. For short-term investors willing to pay for this short-term momentum, probably they will have to be patient and wait a bit longer. The good news is that there is nothing in the global bank share prices right now that reflect this financing opportunity. So it seems that the optionality clearly here is on the upside. That at least is our thought on that.
Okay, thank you. We're going quickly now. Given our footprint, I'm not surprised to receive many questions regarding emerging markets. So maybe Isidoro, you can take these questions regarding how is ESG investing impacting emerging markets, or what is the outlook in those regions. So over to you.
Okay, this is clearly a hot topic. I mean, we do believe that emerging markets are going to dominate the ESG space in the coming years. So, okay, so let me try to give you a few hints on how is ESG investing in the emerging markets. To start with, we would say that for the time being, emerging markets have clearly lagged other regions historically in this context of ESG investing. But we have also seen green shoots over the past year. Flows are starting to increase in Asia and LATAM as investors' interest in ESG is growing and a stronger regulation is coming into place. This is key. Regulation, I believe, is what was the first catalyst here in Europe and in the US as well. In Latin America, ESG investing, therefore, is marginal, but is gaining weight. So far this year, they have issued close to 25 billion US dollars, meaning almost one third of all the total issuance of this type since 2015. But again, in terms of market share, it's small. It's only 2% of the total. So a lot of space to grow. However, the theme again is gaining traction. There is increasing awareness among both issuers and investors of sustainability themes of all what we've been discussing today. And we can see that clearly as if we look at the creation of dedicated ESG indices in the region, which there are quite a few of them. And moreover, pension funds in Mexico with asset under management of more than $300 billion will be obliged to integrate ESG into their investment strategy as soon as next year. So this gives you an indication of how it can evolve in the future. So in our view, regulation will be the key topic. And as we have more regulation in place, we would expect more investment in this ESG space.
Okay, thank you, Isidoro. Thank you, Anna.
You're
I'm
welcome.
afraid we are running out of time, and we must finalize the webinar. On behalf of our audience, I would like to thank you once again for your great presentation. It was a pleasure to have you today and learn how the energy transition is impacting the business cycle and how sustainable investing is transforming all asset classes. So with this concludes the webinar. Thank you all for attending. We hope you have learned and enjoyed this presentation, and hope you might join our next webinar on behavioral biases in investment decision making, which will take place next 26th of October. Goodbye.